Hey friends, Mayhem coming to you Monday, June 20th. Hope everyone had a good day off. If you didn't know, the markets were closed. That's why they were very stable today, which is nice, even if it takes having to close the whole system down other than the futures. But hey, we did it. And futures are up a little bit, about 1% overnight on the S&P. As I read this off at 7:44 p.m., just ahead of the Globex. And this video is sponsored by TraderAid, TraderAid.com, helping retail investors and traders become more consistent. We're a micro to macro service focusing on trading ideas, research, analysis of what's going on in the market. We also provide informational and educational resources, courses, coaching, live video streams, as well as recaps on video as to what's going on in the market. So if you like the kind of content you see on my Twitter and my YouTube, or if you like the kind of content you see on Horse's Twitter, or both, even better, you're going to love TraderAid. It's only $200 a year or $20 a month. Anywho, wanted to talk about some charts here. There's a lot of stuff going on underneath the surface in markets. And what I'm going to do is I'm going to start these little videos where I take some of the charts that get the most interaction on my Twitter feed, and I turn them into a video available for all on YouTube. So, if you like what you see on the YouTube, also consider liking and subscribing. If you haven't seen me on Twitter, check me out, Mayhem 4 Markets, Mayhem the number 4 Markets on Twitter. First chart we have here is which of the following, if any, will you consider doing if higher prices persist? This was a poll that CNBC took, and it's really talking about what consumers are going to do in America if inflation runs hot. And you can see the chart's a little bit cropped on the right. It's just because I'm not as concerned about those lower percentiles. So really the biggest things that we're looking at, these top items that would affect different industries, which we're already seeing. Cutting back on dining out, right? So restaurants, negative impact. That's the ultimate discretionary expense. No one has to really eat out. You can always make, if you have to, a cup of soup, a bowl of rice, or whatever, a sandwich, a hot dog, a burger, a chicken dinner, whatever, people eat. They can make whatever it is they eat at home most of the time. And if not, there are really low end sort of fast food options in terms of price that people can consider. But at the end of the day, people don't really need to dine out, especially in the sort of, higher tier restaurants that are out there. But even the mid-tier stuff, it's probably pretty vulnerable in this environment where discretionary spending is just sort of compressing across the board. The other area, people are cutting back on driving, and gas prices are really high. Part of that is because we haven't expanded refining capacity requisite with the amount of demand that we've seen. And the other problem is on the oil production side, there hasn't been nearly enough spending in terms of investing in new exploration and production. So we have kind of all three parts of the oil infrastructure not operating at full efficiency: exploration, production, and refining, and that leads to higher prices in the distillates, and it also leads in higher prices in the unrefined. So that's something to keep an eye on, because that's going to have an impact on travel. It's also going to have an impact on just how cost efficacious it is for truckers to move goods. Many can be taken out of circulation, and also for other kinds of services. You could see cost increases in food delivery or package deliveries, or you could see cost increases across the board in different types of goods, because energy is used to move everything, even to grow all of our crops and all that. So, when you see higher energy prices, it has a deleterious impact of cost pushing inflation down multiple areas that impact consumers and businesses, and, government as well. The military in the U.S. is the biggest user of energy on the planet, so it has an impact there in terms of the spend. People are also going to cut back on vacations, and why wouldn't they, right? If you're thinking about a trip and then airlines costs are going up, hotel costs are going up, car rental costs are going up, gas costs are going up, grocery costs, eating out, everything that you would do on a vacation, all that stuff is more expensive. And then people are already being hit by, higher utility bills, higher property taxes, higher rent if they're not owners, if they're renting, higher cost of fuel and energy at home, of food, of everything they're buying, and then they're not seeing wages rise commensurate with those higher costs. So all their, cost inputs are going up, but their, income inputs are not going up. There's wealth destruction, so people that thought they had more money, starting this year feel like they have a lot less money now, whether it's in their retirement or investments they have have outside of their retirement or otherwise. So that wealth destruction impact is also having a sentiment effect, and people are wanting to spend a little bit less money. Kind of up and down the socioeconomic spectrum, but certainly on the lowest end, they can't afford otherwise. But even as we go up to, bottom, 0 to 20%, obviously struggling the most, but 20 to 40% are still having not a great time. And even up to, 40 to 60%, there's still folks out there that are not in a good position. So I would say it's important to really kind of look at what's happening at the consumer level. A lot of families never recovered from the great financial crisis or the COVID crash. The elasticity of their budget's practically non-existent. Anything they had from stimulus or otherwise has pretty well been spent. They're late on their utility bills. They're late on their mortgages. They're rolling their revolving credit. They're basically grabbing as much as they possibly can of credit card debt, and even home equity lines of credit, cashing out their equity if they have any. And that's a very dangerous sign, in this type of an economy, because it indicates that when you look at the sort of credit card spending, by the way, and you subtract for inflation, the real trend is flat and the nominal trend is surging. So what it indicates is people are spending more to get the same or less. And that's why all these discretionary expenses that you see on this chart, they're cutting back. Why wouldn't they? They can't afford this stuff. And it's sad, but it's a narrative of the macro state of affairs of what's going on. And it's going to have a fundamental impact on a lot of companies that are in any of these areas, right? So restaurants, car rentals, people that are selling cars, they're going to see, used car sellers, all those areas are going to see some compression in demand. Vacation booking companies, hotels, airlines, subscription-based services, think about things like Netflix or other things that people may not need, they like having it perhaps, but anything that's easy to cut out. When your costs are going up, you're going to cut it out. And I bet a lot of people listening to this right now can relate to it in their own way. Yeah, I've done a little of that. Yeah, I cut back on dining out, or I canceled a monthly or whatever. I know I'm canceling things here and there just because I always do that. I've always kind of looked at every little bill I have, and if something I'm paying for doesn't make sense and I don't use it anymore, I cancel it. It's that simple. But in this era, people are doing it a lot more out of necessity, or at least to try to make it so their spend is a little bit lower as it goes up in other areas. Switching to a generic product makes a lot of sense. You got a lot of grocery stores that make these. So, you go to like Whole Foods, they've got, their own 365 brand. You go to Trader Joe's, they've got Trader XYZ, all their different brands, private label stuff, Safeway, Giant. A lot of these places have brands that either they make or they contract out. So I think that's important to consider because those generic products are saving people money. It's also shifting where demand is going. So some of the higher end or mid-tier sort of consumable items, they're not going to be as sought after. And I think that is going to have an impact on some of the companies that sell them. One of the biggest examples of this, going back a little ways, was something like Oatly, in the sense that, this was already a product. It was an oat milk product that never really had any edge. And oat milk, quite simply, is really water, oats, and a sweetener, and maybe something to work with the consistency of it to make sure it stays consistent. But oat milk is something anyone can make. It's a very easy process. It doesn't require a lot of resources. It doesn't require a lot of investment. It can even be outsourced. And so every grocery store can make their own oat milk, and many have. And other companies can get into the field. So Oatly's, non-existent moat was completely eroded. They had competition left and right when people started to realize just how popular oat milk was. And so people did switch to generic brands because a lot of the times those generic store-based brands are a lot cheaper. And quite frankly, the quality is comparable or sometimes even better. So I think that's another thing that's important to consider, is that there's going to be this sort of pivot from, in some situations, not all, some name brands have very strong sticking power, but in some situations there's going to be switches from name brands to generics, either out of necessity or at least to free up budget. Delay buying a car. This kind of goes back to cutting back on driving. It makes a lot of sense. You're going to see people delay buying a car if they're not driving as much because there's less wear and tear. They might not need the car. It might not be as urgent, and so they're going to try to delay that and maybe buy a used car or keep their car for longer, etc. Delay buying a home. Home buyer sentiment's the worst it's ever been in history. That's not good. And how, autos are 4% of GDP, but the U.S. real estate market, the home part of the U.S. real estate market is about 15 to 18% of GDP. So between the two, you're already looking at, 19% all the way up to, say, 22%. That's a huge part of GDP that's being compressed. So, that's another thing to consider is just how big all of this compression of both discretionary spend, the durable goods spend, the switch from higher-end products to generic products, automobiles, buying a home, all that sort of stuff. These are big, big, big commitments that people are paring back from. And it's not necessarily because they want to, it's because they have to. And so, there's pent-up demand for sure, but what's going to fulfill it until people get money in their pocket? And that's the concern as we get closer to a technical recession, which will probably, in my opinion, happen this year. We'll also see people that are going to borrow money or take on credit card debt to cover expenses. And we've seen this as revolving debt, as I was mentioning earlier, is surging. That's a big problem. Revolving debt surging means that we're going to have a lot more problems with consumers. We haven't even gotten into the heart of the Fed tightening cycle. We haven't even seen a technical recession yet, and this level of stress is already apparent. So, that's a concern as well, because no one wants to use credit card debt to pay necessary expenses, but they will do it if they have to rather than default, especially when it comes to their utility and mortgages, and those delinquencies, or at least late payments, are going up. So let's move to the next chart. What we can see here is that there's a lot of short selling. We haven't seen this level of short selling since the great financial crisis. And that indicates that we're probably a bit lopsided right now. I think it's important to look at that in the context of what markets have been doing. It doesn't mean it can't get more lopsided. It can. I mean, look at what happened in 2008. It got real lopsided to the short side. And why wouldn't it? Everyone thought the world was about to end. And people sort of are starting to come to that same conclusion now. That, inflation, global recession, this Russia-Ukraine crisis and what the geopolitical consequences of that moving forward might be. China-Taiwan kind of has a lot of people concerned. And then monetary policy and what that's going to do to global rates markets and liquidity. I mean, there's all kinds of sort of big negative macro catalysts. And so people are very, very alarmed. Sentiment is in, sort of like sub-basements of low in terms of where we are in the market sentiment, but also in consumer sentiment and other measures of sentiment. And so what does that mean? It means that people are very, very extreme to the negative side. Now, that doesn't necessarily mean we get a snapback rally, but we could. And there's increasing likelihood the further we get kind of below these extremes that we have seen, even the COVID crash, we're now more concentrated on the short side in terms of what the Goldman Sachs Prime Book is seeing with global equities on week-to-week short flow. So that's pretty alarming. Now, obviously, this short flow is measured in dollars. So if we account for inflation, maybe it's not quite as big as it looks, right? I get that. And if we account for higher nominal prices of these indices, I get it. But I still think it's very noteworthy because it's exceeded the low that we saw during the COVID crash, and also during, and you can kind of see it's like almost nothing here during the 2018 tightening tantrum and all this sort of stuff that followed. So there's not a lot here that tells me that this isn't an extreme. This seems pretty extreme to me. This is, going back to COVID here. This is some of the volatility we saw to start this year and to end last year. And this is where we are now. So it is an extreme. And again, it doesn't necessarily mean it can't get worse before it gets better. But it's noteworthy to show you just how bad sentiment is in terms of this positioning. Housing and business investment is rolling over. So, this is important. We just talked about how big housing is in terms of GDP. We also know that business investment is important because it's a sort of sign of business confidence in the economy and also in their ability, not only willingness, but ability to invest in growing their enterprises. And so both of those are rolling over at the same time, which is pretty recessionary. It really does look like you're starting to see, I would say with capital orders, they're really rolling over. Housing resales looks like it's pretty concerning here too. It was already at really inflated levels though, so I'm not quite as concerned yet about that. But I think what's happening with mortgage rates skyrocketing, with prices still high, and with home buyer sentiment in the gutter, those home resales are going to go much lower. Much, much lower. In fact, I'm sure they have in the latest data set. But the capital equipment orders tells me that businesses have lost confidence in this expansion period, and they're preparing already as of April 2022 for much slower business activity, a much slower economy, and that's important too. And they also can't afford as much capital equipment because guess what? Everything's more expensive. There's shortages, there's supply chain issues. So it seems like we've already seen the peak economic growth in this cycle. And that's something that we should be concerned about, because if you're full cycle investing, or if you're just investing with the primary objective being consistent returns, this is a period that's more difficult to make returns on the long side. Not only because we're in a bear market, but the bear market has structural macro drivers like this. When we look at Japan and what's going on there, I'm just going to zoom out a little bit here. Japan's import prices are surging as energy prices soar and the yen depreciates. This is really bad news because their economy is not doing well. Now, granted, they've wanted inflation for some time, but not like this. Not at all like this. The Bank of Japan can't stop bringing new credit into existence to try to support their flailing bond market. Meanwhile, because of what's going on with a sort of shortage of all the things, this new era of scarcity, Japan is also seeing their import prices surge, and energy is leading that, but there's many other components to this. Obviously food, metals, otherwise, sort of everything is going up in cost. Japan imports a lot. They're not really a self-sufficient nation in terms of their energy or their food or a lot of the other materials that they use for their industries. So that means that these import costs rising is a big problem. So take into consideration what's going on in Japan. The yen is basically in free fall. If you look at it on a weekly chart, it's horrifying. And then the inflation situation, which the Bank of Japan doesn't seem to care about. And I think they do recognize that they can't fix the supply chain issues, and their bigger concern is that if their debt load starts to really become unglued, it's kind of game over in a lot of ways. But nevertheless, this is concerning. And it does suggest that the Bank of Japan's policy of sort of creating an infinite level of credit to sort of monetize the Japanese government's debt, especially given the Bank of Japan's balance sheet is significantly larger than Japan's GDP, that's all very concerning as well, because we're starting to see sort of the law of diminishing returns and some of the limits of monetary policy. And if any country was going to experience the limits of monetary policy, it would be Japan. And if you think of these countries, as houses in a neighborhood, you've got a house that's dilapidated, needs new paint, it probably needs some parts replaced completely, just needs a lot of fixing up. And then you got a house that's on fire, and then you got a house that's burned to the ground with smoldering ash. And that first house that's dilapidated, that's the U.S. The house that's on fire is the European Union, and the house that's burned down to the ground with smoldering ash is Japan. And so, if we do see anything that resembles one of these sovereigns going out of control, something as big as Japan, that's going to be a big deal. If the yen really starts to go into a sort of crash mode and Japanese sovereign debt starts to go with it, that's going to have global impacts. And I'm not saying that's what's around the corner, but that's one of the tail risks as we get deeper into this global recession and bear market, is that Japan could be a basket case. And I think there's early evidence to suggest that possibility. So, turning the page, when we look at the richest of the rich, the top 1% of U.S. households have almost 50% of all the asset holdings. That's a lot of concentration of wealth to a very small handful of people in terms of and I know that's not what this chart's saying, but you have to do the math. These are the top 1%, so they have all the wealth, and they have 50% of their wealth in stocks or close to it, 48%, right? So you do look at other statistics, you see that a lot of stocks are owned by the 1%, and this is one of the motivations for people to say that there's this sort of Fed put, right? Because, the richest of the rich have so much equity exposure that surely the Fed will come to their rescue because of that. And I would say in times prior that was probably true, but with high inflation it's not nearly as true. And the Fed isn't necessarily an ally of the richest of the rich. I think economic elites do have a lot of influence, but it's more an ally of the banking system. It was built specifically to maintain and enhance the banking system, and in doing so, it's kind of handed the controls of the economy to the banking system. We've gone from an economic cycle to a credit cycle, something that we can talk about in a future video. But nevertheless, this just shows the sort of concentration of corporate equities, mutual fund shares, other things like it in the hands of the 1% who are the most, wealthy. They're also the ones who are taking the biggest hit to their wealth in this bear market. Not necessarily supposed to be a silver lining or anything, but it at least kind of tells you that when you see the S&P dropping 4% in a day, these folks are seeing significant destruction of their net worth. And with the kind of bear market that we've had, a lot of these folks are getting hit. And, just because they're very wealthy doesn't mean they necessarily get out of the way. A lot of these folks are buy and hold. They just get in the market and they hold for a long time. So something to think about, just that affects the top tier of consumers. That wealth destruction sometimes gets them a little concerned about just how much discretionary spend they're going to have if they think this is going to be a protracted bear market, or if they think some of that wealth might not come back anytime soon. Essentially, that can have an impact on compressing some of that top tier discretionary spend. And I'm not saying it's going to stop them from flying their private jets or going to islands on vacation or whatever, but it might slow some of the things down that they're doing. And certainly it also constrains some of the sort of Wild West nonsense. Like, I don't know that Elon Musk is going to be able to buy Twitter or another company of its size with how much of his wealth he's lost because Tesla shares have just kind of collapsed, and maybe the Twitter thing was just an excuse to get out of some of those shares. Who knows? I don't know what's going on over there, but certainly he's able to save a lot more money on his Tesla losses if he had stayed long by taking the loss on the Twitter if he takes the deal fee. Right, I think it's like $1 billion or even a $5 billion fee would be a lot less than what he's lost on the Tesla shares if he had not sold them. So anyway, that's neither here nor there. It's just interesting to note that when the top 1% see such a compression of their wealth, it can have an impact on, sort of deals and venture capital and private equity and otherwise. And we're seeing kind of bear markets in those areas as well. China is not seeing the kind of export orders they had. This is a pretty big drop. Part of it is driven by the sort of compression in global activity. I'm sure part of it is also related to what's going on with COVID. But in essence, this is a situation that everyone should be watching because this is a pretty big fall. And that kind of activity compressing this meaningfully in such a short period of time is very alarming. So I would be keeping an eye on China. I do think it's interesting, though, that China is kind of trying to pivot. Their central bank is trying to move more in the direction of easing. So that's something that we should keep an eye on as to whether or not that starts a new credit cycle there. And we have a really great 3-part article that Aisha and I will be publishing on TraderAid about this topic coming pretty soon, as well as on her website that's coming up pretty soon. So definitely stay tuned. If you're not already a TraderAid member, check us out at TraderAid.com. I think you'll like what we offer, and it's at a very fair price. Moving on, we're going to talk about McDonald's. And this is my last chart. This one went kind of quasi-viral. It's not really a chart at all, so I misspoke. But it's my last image. And the reason that I find it amusing is not only because it's funny, but also because there's an apostrophe in bros, which is totally errant and unnecessary. And so it kind of suggests that whoever designed this sign is in no position to be talking badly about anyone. I mean, it's a pretty simple construct of the English language to master. I'm not speaking down to anyone who's not a master of the English language, but if you're putting up giant billboards, they probably should have someone review this sort of stuff. Anywho, I really hope everyone enjoyed this video. It's been a lot of fun to put it out there. You can find me on Twitter at Mayhem4Markets. That's Mayhem number 4 Markets. You can also check us out at TraderAid.com, where we have plans for $20 a month or $200 a year for retail and retail traders and investors. And we're really focused on trying to improve consistency, trying to provide educational, informational resources, analysis, research, trade ideas, and much, much more, including courses and classes. So once again, thank you everyone for tuning in. If you like the YouTube channel, like it, subscribe it, share it with others. I'll see you soon.